Welcome to Wealth Creation Lab. Before we begin, please note that all content shared on this channel is intended for educational and informational purposes only. We are not registered financial advisors, and nothing presented here should be considered financial, investment, tax, legal, or professional advice. We do not recommend, endorse, or promote the purchase or sale of any specific stock, mutual fund, ETF, cryptocurrency, or financial instrument. All investments involve risk, including the potential loss of capital. Past performance does not guarantee future results. Before making any investment decisions, conduct your own research and consult a qualified financial advisor. By using this channel, you acknowledge that any actions you take are entirely at your own risk. Wealth Creation Lab is here to educate, not to advise. Learn, invest, grow responsibly.
Welcome to today's Explainer. Let's kick things off with a little story. Picture an everyday trader, maybe someone exactly like you when you first started out, just completely buried under a mountain of chaotic charts. Today, we're going to take that struggling beginner and guide them through all that relentless stock market noise. We're going from absolute chaos to cold, calculated precision. And our secret weapon? We're diving deep into one of the most misunderstood tools in finance, the RSI indicator. We've got a ton of incredible ground to cover from some of the top financial sources out there, so let's get right into it.
So why do so many beginners totally wipe out, even when they have access to literally endless tools? Well, picture our trader sitting at his desk. It's cluttered, his screens are glowing and flashing with a dozen overlapping indicators, and he is completely paralyzed. He's suffering from something called indicator hopping. Jumping from one shiny magical tool to the next, desperately hoping for that foolproof signal to buy or sell. But here's the catch. Despite all that fancy tech, he's still losing money. Why? Because simply having more information absolutely doesn't equal better execution.
And that leads us straight into a massive mental roadblock. If you follow CA Rachana Renati's masterclasses, you've probably heard about this huge myth, the idea that the stock market is just pure gambling, that it's inherently way too risky. But let's burst that bubble right now. The reality, the market itself isn't a casino. The real gamble is stepping into it without a structured, rule-based system. Seriously, if you're buying and selling based on a gut feeling or just staring at a chaotic mess of random lines, you're not actually trading. You're just rolling the dice.
This basically splits the market into two totally different worlds. On one side, you've got retail traps. That's where our everyday trader usually lives, right? Trading on pure emotion, frantically reacting the second a giant green candle pops up, and getting caught in traps over and over again. But on the exact opposite side, smart money concepts. Think about the massive institutional banks. They operate on cold, calculated logic. They don't guess. They literally hunt for liquidity, figuring out exactly where retail traders hide their stop losses, and then they execute with absolute mechanical precision. If we want to survive, we got to stop acting like retail and start thinking like smart money.
But hey, before we can even begin to think like smart money, we have to speak their language. Imagine stripping away all those flashing lights and chaotic lines from your screen until you're left with a clean, blank slate. What you have left is technical analysis. Put simply, it's the art of reading the market's footprints. It's evaluating trading opportunities by looking at statistical trends, stuff like pure price movement and volume. We're absolutely not trying to predict the future here. We're just reacting, completely objectively, to what the market is doing right in front of us. Now, platforms like TradeBrains hit the nail on the head with this. Before you even think about slapping an indicator onto your screen, you have to master the naked chart. This is the absolute foundation. We're talking about pure price action, drawing accurate support and resisting zones, nailing down those trend lines, unlocking the real psychology behind candlestick wicks, and using volume spread analysis to see where the actual buying and selling pressure is hiding. Because think about it, if you don't know where the market's structural walls and floors are, there is no indicator on earth that's going to save you. All right, so once you've got that solid foundation built, we can finally bring in the star of the show, the RSI, or Relative Strength Index. So what is it? Simply put, it's a momentum indicator. Think of it like a speedometer for price changes. It measures how fast and how far prices have moved recently. It helps us spot if a stock is overbought, meaning it pushed way too high too fast, crossing above that 70 line, or if it's oversold, dropping below the 30 line. This is exactly the tool our overwhelmed trader needs to finally bring some order back to his chaotic charts. But wait, here is a massive warning sign. The RSI is absolutely not a magic bullet. This is where beginners trip up all the time. They see that line cross below 30 and instantly smash the buy button, totally convinced it's a guaranteed reversal. But guess what? In a brutal downtrend, the RSI can stay oversold for weeks while the price just keeps crashing. You've got to remember, the RSI is just one single piece of a much larger puzzle. It's meant to help you find really precise entry and exit points, but strictly within an existing established trend. Now, if we look at insights from the secret mindset, they reveal this incredible hidden feature that completely changes the game. The real magic of the RSI isn't just looking at those overbought or oversold zones. It's in something called divergence. This is like a secret code. It happens when the actual price of an asset makes a lower low, but the RSI indicator makes a higher low. It's telling you that even though the price is still dropping, the downward momentum is actually dying out. It's the hidden footprint of a massive momentum shift. Most retail traders completely miss it, but smart money, they capitalize on it big time. Okay, so how do we actually turn this into a system you can use? Enter the mechanical scalping strategy. This is designed to strip out all human emotion and guesswork completely. Step 1, always align with the higher timeframe trend. If the daily chart is going up, we're only looking for buys. Step 2, map out your support, resistance, and liquidity zones on a totally naked chart. Find where the heavy volume sits. Step 3, be incredibly patient and wait for that RSI divergence signal right at your key zone. And Step 4, execute the trade instantly with a strict, pre-planned stop loss. No hesitation, no crossing your fingers, just pure robotic execution. Now, I want to be super real with you for a second. Even the absolute best mechanical strategies, like combining a moving average trend line with RSI divergence, are not going to win 100% of the time. There's just no such thing. A realistic, highly profitable system might have something like a 71% win rate and a 29% loss rate. And that brilliantly illustrates a key point. Getting stopped out and taking a loss, that's literally just a normal business expense. You absolutely don't need to win every single time. You just need your winning trades to outgrow your carefully managed losing trades. That's it. Let's actually walk through what the life cycle of a perfect, disciplined trade looks like. Watch how our beginner transforms from an anxious gambler into a cold, calculated professional. First up, pre-market. He calmly does his top-down analysis and marks his structural zones. Next, the wait. He gets into sniper mode, patiently watching the charts for the RSI trigger to line up perfectly with his zone. Then, execution. He enters the trade mechanically without a second thought. And finally, management. He completely trusts his stop loss and trails his profits, totally detached from the emotional outcome. Beautiful, right? The contrast here is just staggering. Look at the old indicator hopping way on one side, driven by an emotional mindset, constantly shifting strategies, basically uncapped risk and surprise, consistent losses. Now look at the mechanical RSI system. It's calm, objective, strictly rule-based, with incredibly tight risk management, which ultimately leads to long-term profitability. I want you to take a second and be honest with yourself right now. Which of these columns actually describes how you trade today? And being honest with ourselves leads right to this really harsh reality. 90. That's the percentage of traders who fail. 90% of people wash out because they completely lack a profitable, systematic edge. This is a massive wake-up call, and it's a startling statistic you'll hear discussed on platforms like the FinGrad podcast and by top proprietary trading firms everywhere. Listen, if you're just clicking buy and sell because you have a feeling about a stock, I hate to say it, but you are absolutely part of that 90%. So what is actually keeping that 90% broke? Well, the pros at S&P Capital have flagged 7 major account-destroying mistakes that retail traders make every single day. Let's run through them. Overtrading and trying to force a setup when the market is flat. Trading without a strict stop loss. Constantly jumping between lagging indicators. Totally ignoring the bigger picture, higher time frame structure. Revenge trading, immediately trying to make back money right after a loss. Using improper, oversized positions. And finally, trading without a physical, written plan. Any one of these is a guaranteed account killer. To fight off those brutal mistakes, there's one golden rule you have to adopt immediately. Capital preservation is infinitely more important than capital appreciation. Seriously, let that sink in. Your number one job as a trader is not to make a ton of money right out of the gate. Their primary job is to protect the money you already have from getting eaten by market manipulation. The whole point of combining naked price action with a tool like the RSI is simply to manage your risk and keep your capital perfectly safe until a really high probability setup comes along. That brings us to a really powerful quote, and it's a core philosophy drilled in by the pros at SMB Capital. Become a pattern recognition machine. I love that phrase. Trading successfully isn't about having some superhuman intuition or gambling on a hot tip. It's all about robotic consistency. It's about spotting the exact same price action pattern, lining it up with the exact same RSI divergence, and pulling the trigger in the exact same mechanical way, 1,000 times over. It really is that systematic. Which leaves us with one final, absolutely crucial question. Are you
stay trapped in that endless, stressful cycle of indicator hopping and emotional gambling? Or are you finally ready to ditch the retail mindset, use tools like the RSI exactly as they were intended, and build a solid rule-based system that treats your trading like a real business? The choice, and hey, your entire financial future is completely in your hands. Thank you so much for joining me on this explainer, and remember, keep learning and keep growing.